You can see the numbers here. The 50-week moving average is now at 0.44. The 200-week moving average is now at 0.44. They are almost exactly equal. And when we have this next signal, it's going to be only the third time since the 1970s that this has happened. And last time it signaled a tremendous gold bull market relative to stocks. And we're going to see that again. We're probably going to see stocks trade in a trading range as the money printing gets fired back up, and gold will just continue higher and higher and higher, not stopping until hyperinflation destroys the dollar, and we have to go back to physical gold and silver as money for a while until we can establish a new and more stable derivative system.
Recent market analysis by investor and financial commentator Rafi Farber highlights a rare gold signal that could herald the beginning of a significant bull market reminiscent of the 2001 event. This signal, last naturally triggered in 2001, has recently emerged again, coinciding with gold prices reaching a new all-time high of $2,586. Farber's analysis dismisses the brief 2020 signal as an anomaly due to pandemic lockdowns, focusing instead on the more significant 2001 occurrence. This rare indicator aligns with gold's impressive performance, driven by a weakening U.S. dollar and anticipation of larger Federal Reserve interest rate cuts. The precious metal's surge is underscored by a 21% gain in 2024 and a remarkable 32% increase over the past year, positioning gold as one of the few major asset classes to achieve new all-time highs. This performance lends credence to Farber's prediction of a continued upward trend in gold prices. A key metric in Farber's analysis is the gold to S&P 500 ratio, which illustrates gold's outperformance relative to stocks. The formation of a golden cross in this ratio, where the 50-day moving average crosses above the 200-day moving average, signals a bullish outlook for gold compared to equities. Further supporting this trend, the SPX gold ratio forms a rounding top pattern, a bearish signal suggesting a potential decline in the ratio. This pattern indicates that gold may continue outperforming equities in the coming period. Several geopolitical and economic factors contribute to this outlook. Rising tensions in the Middle East, ongoing conflicts such as the Ukraine-Russia war, and potential economic slowdowns create stock market uncertainty. These factors will likely drive increased demand for gold as a safe haven asset. Before watching this video, please subscribe to our channel, hit the bell icon, and share it with anyone who might benefit from it.
Now, we have an extremely rare gold signal. Before I get to silver, we have an extremely rare gold signal that was only last triggered in 2001. And yes, it was triggered briefly here in 2020, but I'm going to blame that on the lockdowns. So I'm just going to conveniently ignore this over here and say that the last time this actually happened for any natural market reason is in 2001 at the beginning of the last gold bull market. This is the gold to SPX ratio, the gold to S&P 500 ratio. And this ratio goes up the more gold is outperforming the S&P 500. So the last time we had a golden cross of the 50-week moving average moving above the 200-week moving average in the gold to S&P 500 ratio was in 2001, late 2001, early 2002. And you can see the numbers here. The 50-week moving average is now at 0.44. The 200-week moving average is now at 0.44. They are almost exactly equal. And when we have this next signal, it's going to be only the third time since the 1970s that this has happened. And last time it signaled a tremendous gold bull market relative to stocks. And we're going to see that again. We're probably going to see stocks trade in a trading range as the money printing gets fired back up, and gold will just continue higher and higher and higher, not stopping until hyperinflation destroys the dollar, and we have to go back to physical gold and silver as money for a while until we can establish a new and more stable derivative system. And if we zoom in on this chart, I can see here that there is a head and shoulders bottom here in gold relative to stocks. So I think the bottom has been in since 2022, October or January 2022 over here. And we're going to be heading higher for the long term going forward. And you can see here the more exact numbers. The 50-week moving average is about 0.440 and the 200-week is at 0.442. The 50 is about to cross above the 200-week moving average any week now. It could be the next few weeks. And this is one of the rarest long-term gold bullish signals that exists in my bid. We have silver open interest has reset down 60,000 contracts since May of this year. That's 33%. This is a massive fall in silver open interest in the futures market, the amount of contracts that are open in silver trading. in only a few months. That gives silver a lot of fuel to move higher as speculators will move in, especially if we sort of sustain above 30 again, and then we can move from there. So I want to give you this fall in open interest in context to show you how deep it actually is. So the last fall we had of this breadth, about 33% or 60,000 contracts. Anything close to that was, this is actually more. So the recent open interest down during 2020 when silver hit $11 or something like that, or was it even $10.50? I don't remember exactly, but it was a huge crash. You'll remember it. This is the steepest fall in open interest since then.
The Federal Reserve is set to announce its first interest rate cut in more than 4 years this Wednesday, with policymakers expected to debate the size of the move just weeks before the U.S. presidential election. Senior officials, including Fed Chair Jerome Powell, have recently hinted that a rate cut is imminent as inflation trends toward the central bank's 2% target and the labor market are cooling. The primary discussion among Fed officials will likely center on whether to reduce rates by 25 or 50 basis points. This decision marks the first rate cut since March 2020, when the Fed slashed rates to near zero in response to the economic fallout from the COVID-19 pandemic. With inflation easing and economic conditions stabilizing, a new cycle of cuts appears imminent. However, financial analyst Rafi Farber warns that this upcoming rate cut could signal the beginning of the Federal Reserve's final rate-cutting cycle, which may have severe consequences for the U.S. dollar. Farber believes that once systemic economic weaknesses become fully apparent, the Fed will reduce rates to zero again. He argues that this could lead to a collapse in the dollar's value and potentially cause a broader breakdown of fiat currencies globally. Let's get back to the interview.
And though I do believe there is $1 crunch ahead of us, and you got to be careful of that because the spot prices for both gold and silver are going to head down in the final dollar crunch. We have built up the fuel in the silver market for a sustained rally. Gold appears to be on the verge of a short squeeze, though it hasn't been confirmed yet. And the Fed is about to start its final rate-cutting cycle, which in my view will destroy the dollar, especially once the final plumbing problem becomes known to all and they cut back down to zero and all fiat currencies will be destroyed after that. It looked a little bit this week that we could be entering a gold short squeeze, but no, not quite yet. The reason I say that is that open interest surged higher by 24,755 contracts yesterday, Thursday, September 12th. This is from the CME website, a screenshot from that. And this, of course, is Gold Charts Are Us, which gives us the price action versus the open interest on the bottom here. And I put in this little candle because these charts are 1-day lag. So open interest is now at 538,000. Yesterday's was 513,000. You can see a big move in open interest higher. And that means that more short contracts are being opened. More short positions are being opened. For every long, there must be a short in futures markets. If we had seen a big drop in open interest yesterday rather than a rise, then we could say that we were in a short squeeze. But what is happening is that the shorts are opening even more short positions and they're getting into an even more dangerous position. Let's see historically what happens here. When you have highs in price and open interest, every time when we had this little quadruple top over here that was only broken at the beginning of 2024, right here at the end of this line. So the last 4 times we hit this level, we had highs in open interest, local highs in open interest, and then open interest fell. That means that short positions were being closed and that short sellers were either making or breaking even. Same thing here in 2022, same thing here in 2023, same thing here in 2024, and late in 2024 over here, we see this peak that's not boxed over here. But what we are seeing is lower open interest from that peak, and we're still at new all-time highs. I think we hit $2,600 this morning. So if we see open interest fall from here next week or in the next 2 weeks, then we can say that we were in a short squeeze. Can't say that yet. We'll see what happens shortly, pun intended. Are we at about 13 weeks to a repo clog? A repo clog meaning the repurchase agreements that are traded between banks every night is up to $2.308 trillion in volume as of the last read on Thursday. And we have a total of $3.32 trillion available in reserves. So the amount of reserves that are taken up with repo cash is 69.5%, about 70%. We need to get to about 83% for a clog. At this rate, looks like it could happen in the next 13 weeks. So this is very wiggly. That could shorten or lengthen at any time, but generally somewhere around 13 to 20 weeks. And the most recent calculation is 13 weeks. So we're not that far out of a clog in the plumbing, which should bring on the final dollar prices.
With the Federal Reserve set to implement its first interest rate cut over 4 years and the US dollar showing signs of weakness, gold is emerging as a critical safe haven asset. A rare technical signal similar to the one preceding the 2001 bull market suggests that gold may be on the verge of another significant rally. As the Fed's potential rate cuts draw nearer, could we be approaching a major financial shift where gold thrives while fiat currencies struggle? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.